Good morning, everybody. This is John Blank, Chief Equity Strategist of Zacks Investment Research. And today we're setting off on a story of Zacks' study of style boxes, market capitalization style boxes. I think it's going to be interesting. This is a big subject right now. We've got a lot of valuation opportunities that have emerged out of this deep bear market in the mid, small, and large cap space. This is the study that can deliver that alpha to your returns, either in an index pick, a stock pick, or a mutual fund. So before we get any further, let's go through the disclosures. This is typical for our Zacks professional services slides, and I'll let you read most of it, but I'll read a little bit. The views of John Blank, myself, I am a PhD, are not necessarily the views of Zacks Investment Research, and past performance is no guarantee of future results. So the rest of us, please read it on your own leisure, and we'll get going. So today's story is about updating your stock style box. I want to compare the top stock picks in large, mid, and small caps. So I put this into two parts. First of all, we'll talk about the big picture of stock market capitalization, and then we'll get into the stock style valuation and fundamental narratives that are within those style boxes on given stocks. At the end of the day, you're still building a fundamental toolkit from the individual stocks into your mutual funds or ETFs, indexes that you track. All of this is related to each other. So we're going to go through it in detail. So keep this in mind, and I'm doing this on June the 20th. Okay, so number one, part one, the stock market capitalization big picture. Most of you may or may not know what a style box is, so I want to get through what an actual style box is before we go any further. A style box has 9 squares, and it is used to group stocks and mutual funds into their respective investment styles. You've heard about these styles a lot. You probably haven't grouped them together before. So the vertical axis is creating a representation of the investment size category. So vertical groups will be market capitalizations, large, middle, and small. So that is one vertical style box of large cap, mid cap, and small cap. The horizontal axis, the one running across your screen, will be the fund's investment style categories. Typically, there are 3 of these: value, blend, and growth. So a large cap fund can be large cap value, large cap blend, or large cap growth. A mid cap fund can be value, blend, or growth, and a small cap could be value, blend, or growth. The question we're going to ask today is, what market cap style amongst these 9 should traders and investors buy now? That is a very big alpha generator if we can get this story right. Let's go on. All right, market cap cumulative index returns. I'm showing you the 25-year charts here for 4 index providers. Now, this market for the index providers can be divided into a number of index providers, but these are the 4 big ones. S&P, of course, Morgan Stanley, Capital International, MSCI, Wilshire, and Russell. So once again, S&P, MSCI, Wilshire, and Russell. Now, what I've got here for you is the large cap box running at the top, the mid caps in the middle, and the small caps at the bottom. So this is going to be my large caps, this is my mids, this is my small. Now, within this, you can see, for example, at the top of the Wilshire large cap value is the blue line. The Russell 1000, which you may or may not have heard, that's not the 2000s, it's the 1000s, so the larger cap ones. And then we've got the MSCI large cap growth. So for these 3, I've got growth, and growth indexes. And this is my style box for that group, that one of the 9 boxes. Here, I've got a mid-cap 400 in blue, the Russell mid-cap growth, and the MSCI mid-cap 450. So these are all growth, and that's just one of the 9 boxes. Down here, we've got a little bit of a mixture. We've got S&P small cap 600, MSCI small cap 1750, and the Wilshire small cap value, which is actually a growth, and growth. So these are all growth, these are all growth, and this one has growth. So basically, we're not really studying value here other than this one, but all things taken together, you can notice that they all track one another. So this is the key thing. Really what you want to do is compare something that's MSCI to MSCI, and something that's Wilshire to Wilshire, and something that's S&P to S&P. If you go across index providers, it's kind of harder to pick out the differences. But by and large, you can see what's happening here. Let's take this one, large caps. Okay, so basically large caps rally during periods of cycles that go up, and then they decline in front of recessions, and then they come out the back end. But we can see here we've had a nice 10-year long run. We had the COVID pandemic, and now we're back. Whether it's the Russell, the Wilshire, or the MSCI, they're extremely strong returns. I would probably not wait a lot on this because you can see back here, these are basically starting at different index points. But I would take advantage of the Russell to its own self index because these are correct. So here the Russell 1000, 200, 300 returns over the last 25 years. The Russell mid caps 3,400. Fascinating story here. The last 10 years have really been about the large caps, but before that time, the mid caps were actually the spot to be. So that's the one thing we want to look today is that maybe the mid caps is where we need to be focused in this market. However, down here you find another thing that's interesting. The Wilshire small cap value was actually, in a returns perspective, over the last 25 years, the spot to be in. Again, I would discount this because again, you can see we're doing the S&P 600 from 95 versus this one at 91. But at the end of the day, the Wilshire versus itself, Wilshire is at 2057 up here, and the Wilshire down here is 3768, almost a doubling. So in general, it used to be the case that small and mid cap stocks were much stronger performers than large cap stocks. Something has changed in this environment in the last 10 years, principally because out of that period of the financial crisis and out of that period of the tech boom, we've somehow managed to create just very large companies that grew profitably and everybody traded on them. That actually, going back a longer period of time, is not the case. So this is the thing to think about. Cycles tend to generate new leadership, and this may be the time where we get new leadership. And that's why I put this whole thing together. Is it a time to pick the new leaders? All right, so let's talk about the bigger picture here about the Wilshire 5000, the most broad index, and the macro variables for the United States. Here at the top, we got market cap to GDP. These are basically the recession indicators that are showing you when GDP is basically negative. It's all it's really showing you. But what I want to show you here is, indeed, the market cap to GDP for the United States is basically at a very high level. So we're very fully valued. You would get worried about that. Down here, we got a lot of different things: industrial production, commodity price index, CPI, and the Chicago PMI. So the Chicago PMI obviously goes way down in periods of recession, and it's basically around 60 when it's very strong. This is where I think it's most interesting. The Wilshire 5000 to GDP is obviously gone from around 0.9 or even down to 0.5 during the financial crisis, all the way up to almost 2. You would think, oh my God, how can this be? Are we now in a bubble? But this is where this comes in, this chart. M1 is monetary, the Fed's version of very monetary policy. M2 is a little broader one in the unemployment rate. And as you can see, for example, M2, the broadest version of money for 25 years has been way, way up, particularly since the COVID pandemic. M1, same story. So the Fed has really been pumping money in, and there's much more liquidity in the markets than there's ever been. And yes, this is actually consistent across here. You can see that this beginning period of tech bubbles was when the valuation got extraordinary, and then when the money printing came out the back end of it. And that is the story here. I don't know if you can compare this over time as well without understanding the monetary variables that are driving stocks. The more money that's printed, the more risk that's taken, the more valuation is put into the stock market. And this needs to be understood very closely. All right, so in this performance that I'm doing today, I've got three style categories, about 10 stocks in each. I've got 11 here at the large caps. I've got about 10 in the mid caps, and I got about 9 over here in the small caps. These are the actual names of the companies and the tickers. This is the fiscal year end, which can change a lot for different companies. It's not really too relevant, but I want mainly for you to be able to use this when you go back to Zacks.com and finding out who these companies are. So Applied Materials, the chip company, Target Corp, and the retail company, another chip company, Texas Instruments, and then we've got Union Pacific, ADP, Altria, Thomson Reuters, Colgate Palmolive, Archer McLennan, Amgen, and Caterpillar. These are names you certainly know. Mid caps you may know. Williams Sonoma, particularly, when you would know. Flex, of course, Pentair, Sealed Air. These are pretty well-known names. And then down here in the small cap world, you do have a lot of names that you do or do not know. These are much smaller companies, but they are, for a large part, industries. You can go across many industries. Just because they're small doesn't mean they have diversification for you. They actually do. So that gets into what groups them best. So style box at a fundamental level are best grouped by the amount of sales in the company. So here's the 14-year consensus sales estimates. This is the current year, and this is the current year. This is the next fiscal year. So these are basically showing you the growth rates. I think we can just focus on this over here. I just want to point out, when you have a big company, I'm looking at 15 to 25 billion in sales a year. These are big companies, 15 to 25 billion sales per year. These down here, the mid caps, it'll be around 5 or 6 billion per year. And down here, you can see for small caps, there's a big variation. A lot of growth, but they're very small in sales, about 1 billion or even 400 million for sales. So the idea here is, you can see this is just growing out, a big monster company and getting it bigger. That's the stock play here. Here, not as discernible a value, but we're going to find out there's a lot of profits in these companies here. And then down here, this is the growth story. You're looking for companies that can do really well. But I will point out that there are big variations and a lot of cyclicality in the small caps. They tend to get sold off during these periods of crisis. And you can see right now, the small caps really got hit in the last bit. The COVID pandemic really was a place that hurt the small caps. However, it did not hurt the mid caps. And you can see here, it really did help the large caps because they are all doing quite well and accelerating the earnings through the pandemic. But by the way, I would point out that we're not outside the pandemic. We're done with the pandemic. This is backward looking. Right, quant metrics. These are fascinating. This is the story of the market caps. Again, large caps are between 35 and 100 billion. Here I've got mid caps around 5 billion, and the small caps are around $500 million to $1 billion. So this is your main category grouping. And you can see that the betas can typically be lower for large caps, higher for small caps and mid caps. Not always the case, but that's the general case. The other thing to point out here, return on capital employed. This is fascinating. Return on capital employed for large caps is very high. You can see that. So the return on capital employed for the large caps is really excellent. And I can't tell you why that's the case, other than if you get a big company, it tends to focus on making money. You get a small company, it tends to focus on growing sales. So its return on capital employed would be very much less because it's just not the focus of the company. Large caps do drive for profits, small caps tend not to. So returns accumulated over the last 20 years. I've got 4 time spans here. You can get the 21, the current period is over here to the right or to the left, or to my left, your right. Then we've got the period here. This is a period where you can see a lot of negative returns. That is because of the recession, the big recession period. And then back before that, that was even 4. So these are studying actual periods of time that you can look into and begin to understand what types of environments, what types of rotations are available to you. This is where you get into the story of where we can find the next part of alpha. Is it going to be mid caps, small caps, or large caps? All right, so that takes us through the fundamental overview of what a style box is and the big picture stuff. Now we're going to get into the narratives over the last 25 years. So again, this is taking on core and blend and value and growth ideas and putting them out into specific stocks and studying whether they should be value stocks or growth stocks or core stocks. And this is really another part of the style box is just looking at the actual given stocks. So first off, we'll start off with a very broad level. You all know this one, the forward 12-month PE ratio for 5 different stocks. I want to point out here, you've got a very rich environment for valuations in the last 5 years for large cap stocks. And actually, you can see here, both the mid and the small caps are declining in valuations. This is probably the result of the worry about the small caps not being good players in the recession period or the exit of COVID. It was really an environment where the large caps got played. And you can see they got played into style categories like growth and value. Down here would be your Altrias, up here would be your ADPs. And you can see that this spread of growth and value spectrums is really wide for the large caps, and it got narrower for the small and mid caps. This is not always the case. You can see back here, it was much more volatile for the small caps. Now they're all declining. The question you have to ask yourself is this where the value is? If there is not a recession, or you buy the bottom of the recession for mid and small caps, you may really have a play here. So enterprise value to free cash flow is another version, maybe a more accurate version of how to look at this. Same companies, different story. But again, what we see here is down here how volatile the small caps are versus the large caps. But then in the middle, how incredibly interesting this area is. It's not volatile. These are actually the least volatile, the mid caps. I don't know why that is. My guess is this is the spot where you can grow a business profitably and you don't have a lot of pressure from the forces that large caps face later on when the companies are more mature in their size. All right, price to free cash flow. This is really not as helpful. All I want to point out here is price to free cash flow. A lot of negatives here for small caps in previous periods, but not now. And up here you can see it's getting a little noisier for small caps. We can't make much sense out of this chart. Net profit margins are much more interesting. This shows broad differences across the styles. And I want to point out mainly that growing a business size does increase margins. Look, these guys are doing great for the margin perspective. Stock market perspective of larger companies, middle companies are much greater than small companies. The focus is on sales growth here. The growth up here is profit growth. So profitability, the growth of the last 20 years has been in these large cap companies. They've been profitable. That's why they've been bought, because it's been a profitable period, record profits, and a lot of them went to the large cap. Question is now, is this spot, the mid caps, the spot, or is it the small caps? We will find out. All right, earnings retention. This is not helpful too much. I just want to point out what earnings retention is. It's the plowback ratio, the amount of income retained as earnings after dividend payments. So this is just about how the company runs its finances, internally or externally. Basic point here is large companies can get debt from the outside is more easily than small companies. CapEx to depreciation. What you're going to find out here is large cap companies spend more money on CapEx. That's what makes them big. They have big industrial bases. They can afford the structures and equipment and investment, and they do it a lot more. So you're going to see this story here, TXN, Target, UNP, that's the big railroad, versus down here, these groups are very, very little in that respect. All right, sales growth. I just want to point out a couple things here. Trend sales growth in the pandemic period really hurt the small caps. This is why they sold off. You can see how they went down. But you can also see, there's big cycles for sales growth, but they generally were not cycling as much in the mid caps, and you can definitely see that for whatever reason, the small caps did not do well during the COVID pandemic. Shutdowns really hurt small companies. All right, EPS growth. The one thing I want to point out here is AMAT, which is a chip company. Look at those profit cycles. That's impressive. The other thing I want to point out is CAT. CAT's the brown line. You can see CAT, not as cyclical, a little later, but CAT and AMAT are actually tracking each other in terms of profit cycles. Fascinating stuff. Again, you're looking at a lot of compression here down in the small and mid caps. Much more activity in the large caps. That's why they get bought. Book value to sales over the last 10 years. All I want to point out is occasionally get a company that does real poorly, particularly in small caps because they lose money. All right, dividend growth. This is really the story of bigger companies versus small companies. You want to look into your Amgens here. Amgen's a good story. It's a biotech company, large company that earns a lot of money and grows its dividend. That's why people buy it. So anyways, I hope this is helpful. I hope if you buy these companies and get these charts, you can start to study these companies, these style boxes, these mutual funds, and these groups better by understanding these different groups better and their components better. So thanks for attending today. I hope you liked it. These really are about getting the slides to you that I have created for you, my team and I. So if you want to get a hold of these slides, here's where I would go. 866-794-6065. Strategy call at zackspro.com. You can find us on LinkedIn or Twitter, or go to our website at zackspro.com. These are the slides that we can produce for you. This is our company's product. It really does deliver alpha for your portfolios. And I truly encourage you to step up and find your way to these charts and call us again. Those are your numbers. Please go ahead and pick up these slides.